Hi everyone, it's Alex King here at Cestrian Capital Research. Welcome to our webinar. It's currently Thursday, the 5th of December, just after 4:15 Eastern for the benefit of the tape. So a really special webinar today. We've had, I'm delighted to say, a whole host of new folks joining our various pay services. And a consistent question that we get from new joiners is, how do you make sense of the stock charts that you, Cestrian, prepare and put in the services? So I thought it would be a good opportunity to address that and actually to sort of take a step back and go, well, why use stock charts at all? And to some of you, that will be a obvious question to answer. To others, it will be not at all clear. My own personal journey with technical analysis, as people call stock charts, quite a grandiose name if you ask me, is my background is in venture capital and leverage buyouts. And in that world, the entirety of your job pretty much is fundamental analysis. You don't deal with publicly traded securities very often, and so stock charts are not really a thing that you deal with very often. When I started investing my own capital, I found that fundamental analysis was still really, really useful to distinguish between good quality companies and poor quality companies. Again, companies, not their stocks, companies. I found that fundamental analysis could really help me spot buying opportunities. So for instance, in late 2022, you could buy Meta platforms for somewhere between 7 and 7.5 times the last 12 months cash flows. And that was extraordinarily cheap and screaming buy opportunity. And we said so in the services. What I found that fundamentals was not very good at was telling you when might be a good idea to sell. Because as we know, when markets get frothy, well, valuation multiples can just keep rising far beyond anything that anyone can think to be reasonable. And I started looking for a different method, and I came across various forms of stock charts, quite basic to begin with, and then I embarked on a journey which I'm still on to become better and better at technical analysis. And it's changed my life from a investing and trading point of view, transformed my ability to make money both long and short. And these days, the majority of my time is spent on chart analysis, not fundamental analysis. Fundamentals are still important, again, to understand the quality of the underlying issuer. But from the point of view of timing entries and exits, be they long or short trades, I found that charts are just a whole lot more useful. So I want to share a little bit of that experience here, and we'll cover some topics that are perhaps basic, perhaps more complicated, but we'll go through and see how we go. We'll do some live Q&A, so I'm going to talk through a disclaimer in a moment. After we've done that, I'll switch microphones on, and so if anyone has questions, points, comments, anything at all, just open your mic and shout into the system. You can also, there's a Q&A function here in the webinar platform, and there's a comment function in the webinar platform as well, so you can use that if you have questions. If we don't have any questions, that's fine. I'll just, I can talk for days on this stuff. If we do, that's great. We'll do them on the way through. And if we run out of time, then we can always deal with them in YouTube comments or something like that. Okay, well, look, for now, let's move on. Let's do our disclaimer, which is on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Cestrian Capital Research, its employees, agents, or affiliates, including the author of this note or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the author as of the webinar's date of publication and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Cestrian Capital Research. Cestrian Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so back up to our contents for a moment and let's get microphones switched on. So as of now, mics are open. So again, if you have any questions, points, comments, just open your mic and shout. Okay, let's get going. Okay, first up, let's deal with what is a stock chart. Okay, let's take it right back to basics. And whether you are a long-time technical analyst, or you're just getting started, or you don't know what a stock chart is, or you do, but you don't know why anyone would use one, I find with any sort of analysis like this, take it all back to day one. This happens to be Caterpillar stock, doesn't matter what it is, but this happens to be Caterpillar. The basic elements of a stock chart are that it displays the price of the stock. This chart uses something called candles, but you can use a line or other things. But it displays the price, the movements of the price over time. In this case, this is a so-called weekly chart, a weekly interval. So each colored bar, each candle here represents a week. A green bar up, red bar down. We then have the time frame. This chart spans some years, so it goes back to around 2015 to around the end of 2024, so it's a 9-10 year time frame. And then we also have volume down here. Now, this is volume by time. We'll talk about a different kind of volume later. So for each of these intervals, for each week, on this weekly chart, we can see, was there a lot of volume traded, so a big bar on the histogram, or not much volume traded, a small bar on the histogram. And if price fell whilst during the course of that volume of trading, the histogram bar is red. If price rose, the histogram bar is green. Now, that in and of itself is what a stock chart is. That's not very interesting, but that's the basics. These are the things that do not feature on a stock chart. Revenue, no mention of that. Earnings, no mention of that. Cash flow, nothing about that. There's nothing about Caterpillar's balance sheet on that stock chart. It doesn't tell you whether the company is levered, whether it has net cash, whether it has been bleeding cash lately, or whether it's enjoying a wave of money coming in the door. There's nothing about the fundamental valuation. It doesn't tell you what the PE ratio is, or the revenue multiple, or the cash flow multiple. It doesn't tell you anything about Caterpillar management. They could be wonderful, they could be terrible. It doesn't say. And there's nothing in there about the company's prospects. You know, is it likely to sell more or less machines next quarter? It doesn't tell you anything about their products relative to the competition. It doesn't tell you anything about their size of addressable market. There is no reality. There's nothing to do with the real world on that stock chart. The stock chart is only about the stock. It has absolutely nothing to do with the company. This is sort of point zero about using stock charts, which is what you're analyzing here is not the company, okay? The company, you can go and analyze with fundamental analysis. You can look at all the things I've just said, numbers, management, product market fit, all of that stuff. That's fundamental analysis. That has nothing to do with the stock chart. The stock chart has to do with the stock, the security that is issued by the company and which trades on the exchange where you can buy and sell it. And in our work, you'll often hear me refer to companies as issuers, just an issuer. It's just a thing that issues the security. Because you know what? You're not buying and selling the company. You're simply buying and selling securities that the company issues. And that could be common stocks, it could be options over common stocks, but it's a security that the company issues. The next most important part of using stock charts is this. Now, if you're old like me, you'll remember the Matrix series of films. If you're not so long in the tooth, then the concept here is very simple. The vast majority of investors and traders live within, let's call it a matrix concept, where they believe that stock prices respond to things to do with a company. They think that changes in revenue, changes in earnings, changes in the balance sheet strength, things that happen with a company's products, things that happen with a company's management team. The vast majority of investors think that those things are determinative, principally determinative, primarily determinative of changes in the stock price. Anyone who has learned to invest and trade using stock charts knows that that's not true. Reality, of course, has some impact on stock prices, particularly at the extremes. So we saw with SMCI recently that their auditor, EY, resigned, sent a stinking letter to the company and onto the SEC and published it on Twitter. That's a pretty bad thing to happen to a company. It hit the stock. So sometimes reality can hit the stock. But oftentimes, the only thing that impacts the stock price is the stock price itself. So this is a blue pill, red pill situation. Blue pill, stay within the matrix, a world of comfort where you can tell yourself narratives that say, well, if revenue grows at rate X, then the stock price must change at rate Y. Red pill, step outside the matrix, see reality how it really is, which is that this, the stock chart, has absolutely nothing to do with this, or I should say barely anything to do with this. This is primary and this is secondary. Price matters, other stuff kind of an input that doesn't really drive price. And the red pill, blue pill point is, for me, the absolutely critical point on the journey of public securities investing and trading. This does not apply nearly as much in unlisted securities, be that unlisted credit or equity or whatever it might be. This is primarily in publicly traded securities. The red pill point says, this here, this is my reality. And very specifically, the level of, if you like, alienation one must reach between you and the underlying company is when you come to realize that everything that you need to know about how to invest or trade a particular stock is encompassed within the stock chart itself. That is a sort of singularity moment, which again, for me, was a complete moment of transformation in my ability to invest and trade successfully in public stocks. Now, for some of you, this is old news. You know this, you do this all day long. For others of you, that sounds preposterous. And so all I can tell you is my own experience, which is when I found out about the red pill option and took the red pill and then took some more red pills and found myself at that moment of singularity, which is this here, this stock chart, this is a closed system and everything I need to know about this system is in here. That was a life-changing moment for me. Now, so why are stock charts useful? Okay, well, this is why. And I'm going to talk here only about big liquid stocks and ETFs. This logic does not really hold so much with microcaps. So things in the real world can swing microcaps much more so than the technical factors we're going to talk about in a moment. So think about a small biotech stock. What's going to change its price the most? Answer, does it have a successful trial? Does it reach a distribution partnership with a pharmaceutical major? Those sorts of things will move its stocks. Does it get a regulatory approval or regulatory status removed? Reality for smaller caps, microcaps, is what changes the prices more than these technical factors. And when I say technical factors, what I mean is a technical factor is a stock chart factor. It's a grandiose word, technical analysis. Technical factors, it just means stock chart stuff. So big liquid names. So your Microsoft, your Apples, your S&P, and Nasdaq, all these things. And even, mid-cap stocks with market caps of, 10, 20 billion, that sort of thing. The stock chart tells you a lot about what a large price-setting investor thinks about the stock price's prospects. Now, what do I mean by large and price setting? Well, it's possible that there are some people on this call who are large price-setting investors. Certainly, we have some subscribers that would fall into that category. But for the most part, a large price-setting investor is a very large asset manager, typically a relatively sleepy sort of firm too, not the TV version of what does a hedge fund investor looks like. These are typically very, very large pension fund managers, sovereign wealth funds with very large amounts of money, which for them to get a worthwhile allocation into any particular instrument, they have to move just a large number of dollars into and out of the security. And it's the size of those investors that make them price setting. To move capital into any particular instrument is and of itself a price moving event. If they start buying, the price is going to go up if they're not careful. If they start selling, the price will go down if they're not careful. And of course, if you are a large investor, let's say you're a big sovereign wealth fund, the very last thing you want is to start accumulating a position in, say, Caterpillar or Tesla or Microsoft or whatever it might be, and the very act of your buying to start moving the price. And so large investors spend lots of time working out how to not move prices until they're ready for them to move. So when buying, they'll break up their buying behavior into small blocks. Those blocks will be traded all around town, different exchanges, different liquidity venues through different prime brokers, different times of day, different days of the week, as many elements of fragmentation as you can think of a large investor will do, and they'll take their time. And it's this breadcrumb trail, contrail, footsteps in the snow, think of it how you will. This is the value of stock charts. So a very simple concept, Wyckoff rotation, you look it up, it's on Investopedia, describes it much better than I can, is a really helpful method, I think. It's not quite perfect reality, but it's pretty good. If you use stock charts, in particular, if you look at volume analysis, and I'll show you that in a moment, you can learn to spot accumulation by large price-setting investors, slow building up of positions in advance of what they believe is an expected move up in the stock. And that accumulation pattern has a very distinctive signature. You typically see sideways range-bound action at local lows. I don't necessarily mean all-time lows. I mean, if the stock has sold off recently, and if it's trading within a range, could be a $5, $10 range for a small dollar value stock, could be a $40, $50 range for a bigger dollar value stock. Doesn't matter, but a relatively small percentage swing range at relatively high volume, and it can be sideways for a long time. We'll look at a chart of the S&P 500 shortly, and what you can see at that time is when everyone was freaking out in the 2022 bear market, large investors were accumulating from around April 22 until around March or April 2023. And if you step back, you can see the sideways at the lows, high volume accumulation. So if you can spot accumulation, that's a really good indicator that large price setting investors are likely to be buying. They're not rushing in, they're not YOLOing anything, they're slowly building a position. And that means if you use this method, you too have time. And all of the work we do at Cestrian, all of the method is basically built on, can you follow large price setting investors around just a little bit behind and ride their coattails? There is no need to try to get in front. There's no need, in my opinion, to try to guess where they're going to go next. That's just guesswork. You can be right or you can be wrong. And if you get run over by a large price setting investor, it's going to hurt. But if you just walk behind them, picking up some breadcrumbs, and you can do that whether you're running, a few $1,000s of your own money or many billions of dollars of other people's money. You can run that breadcrumb trail strategy with really quite large amounts of capital. Again, as long as nothing you do is big enough to move the price. And certainly for a typical individual independent investor, you'd have to be moving very, very large amounts of money to move the price of these big liquid stocks. Not true for small caps, but for the big liquid stocks. And so you can do this, walk behind big investors without disturbing anything. And I find this to be a really good method of risk control, which is to spot what large investors are going to do, try to work out what they're going to do, and follow just a little bit behind, never ahead. The next phase of Wyckoff rotation, and again, you could look it up, Investopedia, Wyckoff, W-Y-C-K-O-F-F, Wyckoff rotation, is markup. Now, markup is another word for momentum. And so you'll see all kinds of investors, specific type of funds, lots of individuals, try to spot breakouts or momentum plays. So in other words, that's when a stock breaks out of a range and moves upwards in the case of a bull market or downwards in the case of a bear market, but goes through rapid price change. I've used the word appreciation here, assuming a bull market, but depreciation can work too. So rapid price change and limited volume. What's happened there is that, again, let's use a bull market example. The large price setting investors have accumulated their stock. They've done so as quietly as they can. Hopefully they've done it without moving the price too much. And then all of a sudden you'll see big news stories appearing about that stock or company all over the financial press, Bloomberg, CNBC, Wall Street Journal, Financial Times, all over Twitter. And all of a sudden it's a great idea. It's this week's, this quarter's, this month's great idea. At which point people pile in because the train's leaving the station. A perfectly good strategy. It's not strategy we adopt in our work here. It's not what I do personally, but it's a perfectly good strategy. Jump on the train that's leaving the station. Hope you've got on the train that's going the right direction and jump off before it starts to slow down again. This is usually price taking smaller investors. And again, I don't mean, my grandpa here. I mean, this can be smaller funds. A $10 billion momentum fund will do this Individual investors will do this. These are price takers. The price is moving up. People trying to jump on the train, that they have to accept the price the market is giving them. That's they're chasing the market. That's the business model. Nothing wrong with that. Perfectly good if you're good at it. But this is late money jumping on the train. And then what comes next is distribution. Now, distribution just means selling. Distribution is the opposite of accumulation. Slow selling of positions in advance of an expected decline in the stock. And who expects it? The large price-setting investors. So if you see a stock trending sideways at local highs, again, range bound, relatively high volume, it's a good chance that's selling by large investors. And so what is likely to come next is a material drop in the stock price. So if you're a simple long-only investor, accumulation is a great time to be building a position. Again, not pile in with all your money, but slowly build up a position. Markup is a great time to sit back and do nothing. Let other people bid up the thing that you already bought. And distribution, slow when you see that sideways action at the highs, that's a good time to, again, slowly sell your position. All of this, you'll see, I haven't said one word about what company it might be or what the prospects of the company or the revenues or the earnings might be. It doesn't matter. And this is not a strategy, by the way, to find the world's, the next Amazon and hold it for the next 30 years. If you can do that, congratulations, that's fantastic. That, in my view, isn't a repeatable method. Right? You can put some skills to work there for sure, but there's a lot of luck here. This method, Wyckoff rotation, this is just about execution. It's pattern recognition and execution. Anybody can do this when you learn how, and this works in a bull market, a bear market, or a sideways market. You can always find something in accumulation, something in markup, something in distribution. And it doesn't have to be this week's wacky small cap. This can be Microsoft, Apple, Tesla, all the big liquid names that probably aren't going to go to zero tomorrow, and therefore your risk in those names is always pretty low. Stock charts, in short, give you a glimpse, just an echo of what the future might look like if you learn how to see these patterns. Okay, do we have any questions, folks, before we move on to something a bit more technical? If we do, now's a great time. If not, then I'll just plow on. Ron, hey, you're on.
Thanks, Alex. I had to turn on my microphone.
Hey.
May I ask that you repeat what you said about these methods work in a bull market or a bear market? In a bull market, it's easy to understand why they work, but how do they work when we're in a bear market and things are either sideways or going up 10 cents a day, that kind of thing?
Yeah,
I don't see how it would work in a bear market. Thank you.
Sure. No, good question, Ron. Thank you. Okay. Well, let's think about different bear markets. Let's think about the 2022 bear market. The indices were falling, and higher beta sectors like tech and semiconductor were falling, but energy was going up. So let's take a very simple example. Let's say you're a long-only investor, so you don't like to short for whatever reason that you don't like to. You like to be long-only. Then in a bear market, if you wanted to apply this strategy, you would find a sector or a stock that was under accumulation and going up, and then you can always find them if you look. Let's say that let's do a thought experiment. Let's say in 2025, let's say tech dumps because it's run up so far, so quickly, there's so much profit in there, people start taking it. And let's say that industrials move up. Okay, so you would, in this thought experiment, you would not apply this long-only strategy to tech stocks, but you probably would apply it to names like Caterpillar, for example. This is not me saying that's going to happen, by the way, or that's my opinion. It's not, it's just a worked example. So you can always find a sector or a stock that's running up when the equity indices are in a bear market. I mean, let's say it's commodities, for instance. So you could do this with a gold ETF, for instance. Let's say the S&P falls through the floor in 25 and 26, but let's say commodities, be that copper or uranium or gold or silver, whatever it might be, are running up. And so you could use this with a gold or a silver or a uranium ETF. If you are comfortable shorting, either actually shorting, borrowing stock and selling it and buying it back, or as is, in my opinion, preferable, which is using inverse ETFs, then you just stand this strategy on its head. So when you see distribution, let's say that you saw the SPY ETF trending sideways at the highs, and you thought, well, that's distribution, people are selling, it's going to drop. Then you might buy the SH, inverse S&P 500 ETF, and you might hold that whilst the markdown phase came. I'll look at a chart about that in a moment. So in other words, you'd bought an instrument during that sideways selling when the price wasn't moving much in the S&P. You bought a short S&P ETF. When the S&P then sold off, your instrument will be rising. Okay, so again, two ways to do this in a bear market. Either find a counter trend sectoral stock, and there always is one, or stand this logic on its head and use an inverse ETF. So that's how to do it. Okay, anyone else, folks, before we move on? Okay, so let's move on. We're next going to come to stock chart analysis. Now, we said at the start that stock charts are, in essence, really simple. You've got price, volume, the interval of each price change you're measuring, and the time frame over which your chart flows. What you're really wanting to do, though, is to apply some pattern recognition. When I said earlier that the stock chart is its own closed system and everything you need to know about trading or investing in an instrument is in that chart, it's because the behavior of large price setting investors leaves a breadcrumb trail. And this is one form of breadcrumb trail that we just talked about, the rotation method. But another breadcrumb trail is the price patterns they leave. Now, there are hundreds of different so-called technical analysis methods, and you'll be familiar with some of the names. Cup and handle formations, head and shoulders formations, double bottoms, double tops, endless. And they're all trying to find the same thing, which is to find repeatable, recognizable patterns where the probability is that leads to an expected kind of price change. And they also, all these systems, enable you to plan for, okay, if the outcome is not what you expected, let's say you thought you saw a pattern that said, well, the price is going to go up next week, but actually the price fell. All systems tell you, well, how do you manage that risk? Where do I place a stop? How do I place a hedge? All those things. The key to my mind is not finding the best technical system. I don't think there is one. They're all just different ways to do the same thing. The key is finding a system which works for you intuitively with numbers, intuitively with visual patterns, intuitively, emotionally, intuitively, psychologically. Because if you find one that you're intuitively comfortable with, in the end, you can analyze things pretty much at first glance. And yeah, you need to draw some numbers and charts and lines and things, but you can pretty often spot things at a distance if you use the same method time and time again, refine your ability to do it. If you think about elite athletes, the top athletes have really three things in common. One, an innate level of skill at some level. Two, a unwavering, never mitigated desire to succeed and continuously improve. And three, a kind of OCD level commitment to training. So if you think about any athlete, you will see them in any sport, you will see them practice their particular move over and over and over and over again. The British footballer, soccer player David Beckham was known for taking penalties and free kicks in training over and over and over again. Would put the ball in the same place and kick the same kick 10, 50, 100, 200 times in training, over and over and over again, to a level where any normal person would get bored, wander off and go and do something else instead. But that's why normal people don't become elite athletes. And the same is true of trading and investing, which is, as a tourist or someone that's in it for, the dopamine rush or the fun, then there's always a new thing. There's always a shiny thing over here. We'll chase over there. We'll chase over there. This week's hot stock, that week's hot stock, Bitcoin, shorting, options. There's always a shiny object somewhere. That, in my opinion, is a terrible way to invest and trade. A way to invest and trade, to my opinion, is find a method that is intuitively appealing to you, practice it, get better at it, be like an elite athlete. And the other thing that you'll find elite athletes behave like is they pretty much lack emotion. You know, if you watch any F1 race, during the race, very, very rare that any of the drivers get excited about anything. They often sound like robots. You know, very often there's periods in F1 where it's accused of being a robotic sport because, you know, everything is to do with controlling vehicle reliability, controlling grip, not getting all excited on the way into corners, not being too emotional and having to brake too early. It's all about controlling emotion. And trading and investing is the same for me. So again, a sort of a nirvana level is if you just made a very large profit and you've cashed it, then the ideal emotional reaction, in my view, is oh. And if you're facing a loss because you've made a mistake, then the ideal emotional reaction is oh, what shall I do about it then? And the amplitude of your emotional changes should be very, very low. Now, Elliott waves, which is the system that we use in all our work, why? Honestly, because I found it very effective. Elliott waves give you a way to measure the emotion of the crowd, you know, the emotion of the crowd that's flowing through markets. They give you a way to spot emotional patterns and to trade against them. So when the crowd is getting emotional, too happy, time to sell, too sad, time to buy. And you can get into unbelievable levels of detail in Elliott Wave. There's lots of sources you can do that. Frost and Prechter have written many books on the topic. Investopedia is good. There's a site called Waveopedia that's good. And we have folks in our community, Fred Frog in particular, the username Fred Frog, who are terrific Elliott Wave analysts that can go into the nth level of detail. I don't and can't, and I keep it fairly high level. This works pretty well for me. Very simply, in an up cycle, an Elliott wave cycle says something like this, that the price of a security will move from this trade point 0 down here to a wave 1 high. It will sell off a little bit. It will lose most of the value created there to a wave 2 low. It will put in a bigger move, a wave 3 high here. It will then sell off some more, not too much, but some more, and then a final shorter wave 5 up here to a top. And in Elliott wave theory, if you're investing long, then the great places to buy are around these wave 2 lows here. The great places to sell are around these wave 3 highs here. Okay place to buy is a wave 4 low, and an okay place to sell is a wave 5 high. So in Elliott wave methods, you're pretty much always looking for, I want to find a wave 2 low to buy. We'll come on to measuring it in a moment. When stocks sell off using the Elliott wave lens, again, it's just a lens. It's not reality. There's other ways to do this, but it's a good lens through which to look at things. They typically sell off in a 3-wave structure. So this might be a bull move in the S&P. So we'll look at that in the NASDAQ in a moment from August this year. And then we might see a sell-off. And typically you see an initial sell, a bounce. So an A wave down, typically called, a B wave up where that bounce doesn't quite recapture the original high, and then often a deeper sell-off, a C wave. And these patterns, again, can be traded. So if you held up here and you held to wave 5, you thought it was going to go higher and it didn't, it started to drop, but you see a bounce here, then usually, not always, you could say, well, at some point I'm going to see a B wave high that will get me most of the way back to where I want to be here. I can sell. Okay, I didn't catch the top, but I sold here. And when the big drop comes, I wasn't around for that. So nothing in reality perfectly matches these, but you see these patterns more often than you would think, again, in the big liquid stocks. And that's not an accident, as we'll talk about in a moment. The next concept we cover in our work is we use things called Fibonacci levels. Now, again, we can get into what is the Fibonacci sequence and all of those things, and by all means, read up about the golden ratio and all those things. And we can ascribe these things to some, magical structural power of the human brain, if we like, or we can say what I believe to be true, which is this is just standard amplitudes of these waves. Okay, as we'll mention in a moment, when you see these patterns and waves taking place, it's not some mystical design. It's that large accounts trade using this method. And again, there's nothing perfect about Elliott waves, and there's nothing that's uniquely brilliant about them. Other technical methods are also available and are effective if you good at them, but this is what works for us. It works really well. At Fibonacci levels, these enable you to measure the amplitude of these waves. What's the amplitude? Most of you will know the amplitude is the move up and the move down, the changes from the wave high to the wave low. A drop in a price, you'll typically see referred to as a retracement. Big word, doesn't mean much. It just means here was a move up and it's retraced its steps back down here. And retracement levels, you'll see some very common patterns. If you overlay, we can do this here. If you overlay a retracement level, you will see that the stock might start down at this price here, move up, and then retrace from this zero level here down to, let's say, the 78.6 retracement. So it's dropped 78.6 of the value that was first created in that wave one up. And you can learn to spot common levels. So typically a wave two will terminate somewhere between the 61.8 and the 78.6 retracement. Typically, not always, obviously. This also gives you risk management. If you thought that it was going to terminate at the 78.6 and it keeps falling, well, probably you were wrong. So then you can do something about it. You can execute a stop or a hedge or just get out. But they give you some guardrails, some expected places where price will fall to before a bounce. Extension levels are the opposite. When a stock is moving up, you can measure, well, how high might this go? So wave threes, for instance, often reach the so-called 1.618 extension of this wave one placed at the wave two low. And we'll look at what that means in practice in a minute. This is just a method to get into. These are just techniques and levels to learn. There is nothing, there's no PhD physics in here. It's just pattern recognition. And any charting tool, by the way, can do this. TradingView, TrendSpider, plenty of other bar chart, plenty of other packages can do this for you. You don't need to calculate the ratios yourself. Your internet site will do this for you. So we use in our work three things. Okay, we use Wyckoff rotation to spot buying and selling behavior by large price setting investors and the momentum driven change in between. We use Elliott waves to spot the ebb and flow of emotion in the buying and selling crowd. So, this is the initial hope. This is the, oh, it's all wrong. This is the, oh no, it was right after all. Everyone gets all too excited. This is the, oh, I think it's gone a bit far. And this is the, I think there's a, in the old Graham Dodd parlance, this is the cigar butt. This is the last puff on the stogie that you found on the street, this wave 5 high here. And an ABC correction is, oh, this has all gone far too, I need to get out quickly and this is selling. Right? This is just emotion. Fibonacci levels give you a way to measure emotion. That's really critical. If you can measure emotion, if you can be calm when other people are getting all stressed out, that is a huge edge. And again, another tool, can't really put this on a chart, is measure your pulse rate. If your pulse rate's much over 60, you're not doing it right. You should be utterly unemotional whether you're printing large profits or facing significant losses that you need to try to control. Then your level of excitement shouldn't change, because that's what the crowd is doing. If you're doing that, that's your edge. Stock charts, in short, are our language. They are a system of signs and symbols. They are a system of signs and symbols through which market participants communicate. If a stock bottoms out at the 78.6 retracement of its prior move up, that is a big flashing sign, a big flashing buy symbol that is percolating through the market to other professional market participants that says this thing has bottomed out and is likely, not definite, likely to go up. And oh, by the way, if it fails and keeps falling, then it might go a lot further, so you need to control your risk. But a bottoming out at, for instance, the 78.6 or the 61.8, that's a sign, that's a symbol, and that is a buy symbol. When a stock reaches, let's say, a really big Fibonacci extension, a 2.618 extension, that is a sign or a symbol that says you might consider taking some profits here. None of these things are perfect. None of them are mechanical. You have to apply your judgment. Where does your judgment come from? Your judgment comes from practicing the penalty kick 500 times per week. No other way around it. Yeah, that's how you get good at it. Charts are a language that you can learn. Duolingo, by the way, could teach them. They don't, but they could. And charts could be taught really easily using the Duolingo method. It's just a video game. It's a language. You can learn stock charts as a language like any other. I'm going to work through some examples now, but before I do, any more questions or comments or anything at all that we want to talk about before we go through some real-world examples? If you do, open your mic and shout, or you can use, again, the question function or the comment function in here. Okay. All right, absent those, let's move on. So here's a worked example. This is the SPY S&P 500 ETF. Now, there's one new thing I've introduced here, and this is this volume by price indicator. Any charting package can do this. This happens to be TrendSpider, TradingView can do it, Barchart can do it. They can all do it. Volume by price just tells you for any particular price level over a time frame you specify how much volume was traded. This vertical bar here, this dotted bar, this is called the volume by price start line. You can think of this as time equals 0. And these gray bars here, these horizontal gray bars, tell you, well, since from time 0 here to the current moment, how much volume was traded at each different price level. Now, what you can see, this is on SPY, is blindingly obvious, which is if you set time equals 0 at the COVID lows here, then you can see that the majority of volume was traded between around Q1 2022 and around Q3 2023. There was a whole lot of, as it turned out, buying here. Was that selling? No, this was buying. Right? How do you know? Because if you watched it in the second half of 2022, the narrative everywhere was this market's going to collapse. You know, the S&P is going to 2,000. SPY is going to go back to 200. It's all over. But price didn't really drop. There were a couple of spike lows, but it was trending sideways in the face of terrible sentiment, terrible news, fear everywhere. Right? So when you see price trending sideways, range bound at the lows, when the narrative is awful, that's probably buying. When you see, what we'll get next at some point is, this could be next week or next year, the year after that, I don't know, but at some point we'll see higher volume behavior sideways at the highs when the narrative is exceptionally bullish, where the future is bright, bright green for everybody. Volume will start to pick up and price will trend sideways, and that will be large price setting institutions selling. Here's SPY though. So we've got this wave one up, which goes from the COVID lows, March 2020, up to the 2021 bull market high. It puts in a 50%, 0.5 retracement. Now 2022, to a lot of people, felt like a terrible bear market, but it wasn't. It was just a 50% retracement in the S&P of this move. Yes, some high beta wacky stocks dropped 90, 99%, but that's what you get with wacky stocks. The S&P didn't do that. It dropped 50% of the value that it created since the March 2020 lows. The NASDAQ dropped a bit more. It dropped to 61.8 retrace. The Dow only dropped to the 38.2 retrace. Now, you can't quite see this at this level of zoom, but this touches that 50% retrace pretty much to the cent. And that's not an accident. Like, again, stock charts, they're a system of signs and symbols. They're a language. They're a way for market participants to communicate with one another through price. Nothing illegal about that. So when you saw the S&P bottoming out of this 50% retracement at high volume with narrative being terrible, that's a big signal to buy. And we make mistakes all the time in our work, of course we do, but I'm very proud of our work in the second half of 22, where we loudly screamed, this market's going to rip, which it did and has, and continues to do so. Now, where will it end? Well, it could end today, right? So what happened this week, this is a monthly chart. So what just happened is the 100% Fibonacci extension of that wave 1 placed to that wave 2 low was just hit, 609 on the SPY. That is about the shortest run up of any third wave you're likely to find in the Elliott wave system. So it could be that we've topped and now we start to sell. If so, probably the market won't just dump, it will go sideways for a while and volume will start to pick up. That has not happened yet, as you can see. You can see that volume up here is very low right now. If large institutions are going to be rotating out of the S&P, they're going to need some time to do that. And what happened back in 21 is it took a good few weeks for this high to be established. This is again is a monthly chart. And so it took 3 months really to prove out this top in late 21. And it took several months to prove out the bottom here. So the beauty of using these big liquid instruments is the S&P is not going to halve tomorrow. In a global, massively economy damaging pandemic with no known cure and everything that happened, it didn't go to zero. It just dropped and then bounced quickly as a result of policy response. So the S&P is not going to go to zero tomorrow. If it starts to trend sideways up here and volume starts to pick up, then you can say, well, good chance that tops in. This will be a shallow bull market high if it happens. In the pattern recognition system, it's more likely that SPY goes to 670 and maybe beyond. Theoretically, we'll go to 770. That would be within the pattern, no problem. That feels a lot, but we don't know. Charts, in my experience, are more reliable than one's feelings about these things. All I'm saying is that right now, this chart does not scream the market's about to roll over and sell. And the beauty of using this chart method and the beauty of using big liquid and institutionally traded instruments is they don't go to zero tomorrow. They take their time. Now, let's look at another example, because this method works on any liquid securities. This is NASDAQ E-mini futures over a shorter time frame. So this is over the course of a few months from the August lows. This is a daily chart, so the interval is a day, time span is a few months. And Giles, you have a question?
Yeah, if you could just go back to the previous chart, how do you get those numbers, like the 0.686? Is that percentage increase from baseline or what?
Yeah, they're okay. So let me just switch onto a chart screen. Just 1 second, and I'll show you. Be with you in a moment. Okay, so what you should see here is this is the S&P 500 chart. This is in TrendSpider, trendspider.com. We're an affiliate partner, by the way, so if you sign up for a trendspider.com paid account using any of our links, we may earn a referral fee for disclosure. TradingView, you can do this in Barchart, stockcharts.com. You can do it in those as well. So this is a standard tool that any of these chart packages will use. And so what I mentioned earlier about measuring the amplitude of these waves, the way to spot where a wave 1 might start is slightly, I suppose, recursive in nature, which is you need to find a significant low. So, you would say the COVID lows was a significant low. What happened to the market, sold off really hard, it bounced. You could also point to things like, if you get into the detail, there was huge federal funds flows, massive options market, hedging reversal, a whole bunch of other things that told you that was a low. So you could call that a trade point 0. And on this time frame, this is a monthly chart, you could say that the end of that 2021 bull market, that was a wave 1 high. And so when you were doing this, you'd sort of guess. You'd say, well, I think that's a wave 1 high, I think that's a wave 2 low. And then you'd say, well, let's measure it, because let's say that was a 10% drop. You go, well, I haven't done this chart right, because a wave 2 isn't a 10%, it's usually a more substantial drop. But how you would do it is you would take just 1 second. Nice if the chart thing works. Okay, so you would take the Fibonacci retracement tool, which isn't working. Okay, let me show you in TradingView instead. This is the NASDAQ, but it's the same principle. You would take the Fibonacci retracement tool like this, and you'd measure it, and it does the ratios for you. And so you would say, well, look, that's a 61.8 retrace there. And you'd say, well, so this is the NQ E-mini futures. This is the August the 5th sell-off low. That's the 22nd of August high, and that's the September low. Now, you can see here, and this is real data, you can see that this cannot possibly be an accident. It can't be that the NASDAQ, the mighty NASDAQ, miraculously bottomed at the 61.8 retrace and then shot up again just by coincidence. That just can't be. Not least because, look, it thought about stopping at the 38.2 and fell through it. It's a language, it's a system of signs and symbols. So in TradingView, and again, TrendSpider and others are the same, you can define which levels you show. You could put the 50% in, for instance. You can include the prices of that level. You can do a whole bunch of things, but you use the retracement tool to measure that drop. And when you've done that, you'd say, well, that's a 61.8 retrace. It's tested it over, it's a daily chart. It came down, bounced, it shot up from that level the next day. It didn't retouch it. That's probably a wave 2 low. And what you would then do, while we're on the topic, is this gets into the projection, and you would say, well, where will this next move end? You'd say, well, I think, and these are only ever guesses and probabilities, you'd say, I think that's a wave 2 low, because, well, I know that was a major low, Yen-mageddon, big sell-off, August the 5th, spike up, wave 1 down, spike down, 61.8 retrace, probably a wave 2 low. Okay, you would say, now I can project where my wave 3 might go. And this, as I said earlier, this is why wave 2's lows are great places to buy, because one, there's a good chance of a big wave 3 coming, and two, if you're wrong, then by the time the stocks drop down here, you were definitely wrong. But the distance, the price change from here to here isn't that much, because guess what? It already dropped 60-odd% of the value created here. And so if you're placing stops or hedges, whatever it might be, then your risk control point isn't very far away from your entry, and yet your possible return is a long way up. So wave 2 lows are great places to buy. So how would you project, where this wave 3 might come to? Well, you take your Fibonacci extension tool here, and again, the other packages all do it. You start at the wave 1 low, you put a marker at the wave 1 high there, place that at the wave 2 low, and all you're doing here is projecting. Okay, so your projection is, well, I think this might get to the 1.618 extension. Why do I think that might happen? Well, answer, because that's the pattern. That's a pattern that often happens. What you say to yourself is, look, the zone that I would be looking to sell the NASDAQ in would be something like this. And those of you who subscribe to our work, you see this chart pretty much every day. So you would say, well, look, I think the NASDAQ is going to run into resistance somewhere up here. I think that it should reach at least the 100% extension of that wave 1 place of that wave 2 low. It probably will reach the 1.236, and it might reach the 1.618. It could go higher for sure, but this is the sort of zone at which you might be thinking, this is where I'm going to sell. So if you were a low risk investor or trader, you might think, oh, it's in that zone now. I think I'll sell now. I've had a nice run from 18,600. I'm now at 21,000. That'll do me. Thank you. I'll sit back and wait for the next fat pitch opportunity. That's how you would do it. And then you would know that wave 4s, by the way, the easiest way to map a wave 4 to see, well, where might it go is wave 4s shouldn't really breach the prior wave 1 high. Okay, there's nothing scientific or mathematical about this. This is just behavior. Remember, system of signs and symbols. So if something sells off in this fourth wave and it goes much below that wave one high, you probably got your chart wrong. Probably the cycle was finished. There was a wave 3 high here somewhere, and that was a wave 5 high here. So if a 4 goes down this deep, it probably wasn't a 4. You probably drew your chart wrong. But if it holds over here, then probably you're due another final fifth wave up, a final cigar butt up. You can also use the Fibonacci retracements here. So you can measure from the bottom of the wave 3 to the top of the wave 3, and you can say, okay, well, where do wave 4s typically terminate? Usually they'll drop to at least the 38.2 retracement of that wave 3 up, and they shouldn't drop more than the top of that prior wave 1 high. So you've got your sort of buying zone. If you like to buy wave 4 lows, then your buying zone is kind of in that box there. And I personally, again, those of you who subscribe to our work, you'll see these in our daily market notes. I draw these boxes on, not because they're perfect or they're definitely going to happen, but because they give you a visual guide to say, there's a good chance up here, this is a selling opportunity, and if it does terminate here and start to sell off, there's a good chance this is a buying opportunity. Again, none of these things are perfect, but they give you a roadmap, a guide, a set of guardrails. That's how. TradingView, TrendSpider, BarChart, StockCharts.com, all these packages, and I'm sure others besides, will help you do this. I hope that helps.
Yeah, thanks a lot.
Great. One question on the webinar from me, a question from AM. Will this work for all the stocks, or is it only useful for indices? It works for all the big stocks. Okay, so any big name stock it works for. So it works for, let's look at Microsoft, for instance. It works for ETFs as well. So if we look at, okay, so here's Microsoft. This is a weekly interval chart. So each candle you see is a week. Time frame from the COVID lows onwards. So this is a real chart that we've had running for a long time. So as the 2022 market started to bottom out, we declared accumulation zones in most of the stocks we covered in around these sorts of price zones. So this is, you can go back and check our work for this, but this is about right for Microsoft. So we said that's a buying opportunity for Microsoft in there. Why? Look, sideways. There's the volume spike. Okay, time equals 0 hit in March 22. Everyone terrified in March 22, as we know. Big institutions buying. They weren't selling, they're buying. If they were selling, the price would be dropping. They were buying. Sideways at the lows, and then look here, you've got your wave 3 up, and Microsoft. The soonest Microsoft should have stopped running up would have been around 435, which is the 100% wave 3 extension, meaning you take your Fibonacci extension tool, you plot the 100% extension of that wave 1 place to that wave 2 low. The highest I would say Microsoft is likely to get before rolling over is maybe 570, and it might, if it doesn't quite get there, then maybe 487. And so you can see this is just a standing chart of ours at Microsoft. We said the markup zone where you would see late money coming in, we said would be around 291 to 487. Now, interesting thing, look at the volume up here, okay? So I hadn't prepared this is just looking at it. So you've got quite big volume up here now at a price range of between, I'm going to say 400 and around 428. So these volume by price indicators are really useful. What you have to ask yourself is that buying or selling? And the tricky part is, and where you need some judgment and some risk control methods is, it could be either, because look, it's not blindingly obvious that that's a top in Microsoft. Okay, it could be, but it's a bit of a shallow top. It could be that the markets are going to roll over tomorrow, and it could be we look back and we go, well, duh, obviously that was the time to sell Microsoft. It could be. Personally, I sold my Microsoft holdings a while back, a bit early as usual, so I was already out. But it could be that this is selling in Microsoft, and it could be that the stock rolls over now. Or it could be that this is late money, panicking about just how much the market has run up, panicking that it's missed it. Most people weren't buying down here. If you were a subscriber to our work in 22, you got the opportunity to buy down here with confidence, knowing that you could play stops down here where your risk was limited, knowing that you had good upside potential here. But most people weren't doing that. And you've had a volume spike here, which is when? September 23. That was an oops, I've missed it, I better buy in. Another volume spike here, January 24. So, oh dear, it looks like 24 is going to be a bull market as well. I better get me some Microsoft. And then the question is, what's this? Okay, it could be selling. And right now, you have to be a bit careful in the market, I would say. The market is, I would say, absolutely euphoric, but a lot of people are bullish. A lot of people are not in the market, and so money pouring in from money market funds could lead to more buying, but you have to be a little bit careful at the moment. You are some way up a wave 3. It's not a wonderful place to be buying in high volume. Volume spikes here, that sort of says be careful, but it could also be very late money buying. Now, how can you use these charts? Well, let's say you thought, okay, that's a bullish look for Microsoft. I'm going to buy. I'm going to buy at 442. Well, look, what you know is that below about 400, there's no volume. That tells you that these volume bars here, it tells you that, look, there was a lot of volume at 425, and there's even more volume at 416. So you could say, well, I tell you what, I'm going to buy at 442, and I'm going to say, if the stock drops to 400, then I'm probably wrong. Probably it was bearish in Microsoft. But I've only lost 10% or thereabouts. But if I'm right and Microsoft runs, then I might get to 570 on Microsoft. So I've got 130 bucks up and 40 odd bucks down. So that's about 3-to-1 risk to reward. I like that. So as long as you use risk controls, so with single stop names, often just simple stop loss orders are good. With the indices, you can use hedging. You can technically hedge single stocks, which is harder. But you could buy Microsoft at 440. You could say, well, look, really and truly 427 should be defended. If this was institutional buying, they'll defend that 427 price. If it falls back to 427, the buying will kick back in again. You could take a bit more risk and say, well, look, if I'm flat wrong and the thing is just going to dump, then by the time it gets to 400, it's going to really sell off. So I've got 10 odd percent down, 30% up. That's a good risk reward. I'll buy. And you haven't heard me say one word about Microsoft's Copilot product, revenue growth rate, remaining performance obligation growth rate, balance sheet strength, dividend policy, regulatory risk, the degree to which it's carried favour with the incoming administration or not. You haven't heard me want to say one word about that, but you have heard me say there's a 3-to-1 risk-reward trade right there in front of your eyes that's appeared simply by treating this chart as a closed system. And that is why stock charts are so useful, and that's why it's worth doing the David Beckham. Practice your penalty 500 times a day until you get really, really, really good at penalties. Okay, a couple of questions coming in. So, Roy, you're on.
Yeah, hi, Alex.
Hey.
I'd just like to say that using this technique, since I've been part of the service, it's totally changed the way that I look at investments. But there is another type of chart that we've seen recently, things like AppLovin. And when I look at that chart, it looks like it's an always up chart.
Yeah.
Obviously, that'll change at some point.
Yeah.
But
yeah.
Is there any way, there's no obvious wave 1, wave 2, wave 3, wave 4, wave 5 here, but is there any way of looking at this and saying, so I've been out of this for a while and I'm afraid to get back in it because it's run very high. How far can it go?
I don't think stocks like this work under the analysis method that I've just worked through. And it's one of the reasons I don't play them, to be honest. So ways to play breakout stocks like this are, look at option flow. So this is not my world. I'm not an expert, and I'm not about to explain to anyone how to do it because I don't do this. And I don't, not my world at all. But a breakout stock like AppLovin or SMCI or any of those, GME crazy sort of stories, if you can see the volume is tiny. right? Absolutely tiny. Who's buying up here, right? This is Joe P Retail. This, the Norwegian Sovereign Wealth Fund is not buying up here. Okay, they're not.
Yeah.
The Saudi Arabian Sovereign Wealth Fund is not buying up here. They're just not. BlackRock's retirement fund is not buying up here. The California Teachers Retirement System is not buying up here. This is Joe Retail. Okay, it doesn't mean you can't make money, but the way to analyze these stocks is different. You have to go, okay, usually with these names, the options market drags the stock around. Usually with these names, the stock is a derivative of the option, in fact. And so you need to look at the option Greeks to predict these accurately. And you can do that in a systematic way, and you can do it in a way that isn't just wild guessing. But that's not my skill at all. And as a result, I don't do it. And I don't play these stocks as a result because I'm not good at it. And if you're going to do this, then you have to become a really good momentum investor and learn momentum tools. So you would, the system I've just described, what you're looking for if you chase these stocks is you're looking for this breakout and you're looking for evidence of the breakout. And so again, usually options Greeks are the place to look at that. You often looking for highly shorted stocks that suddenly start to buy and get a short squeeze on. This method doesn't work for this, and it's why we don't cover AppLovin, we didn't cover SMCI on the way up or on the way down, GME, any of these names, because the methods that I'm good at don't suit this. And one thing I've learned is you can't be good at everything. You can't just say chase bright shiny objects. If you're good at spotting these sorts of squeezes, brilliant. You'll have 4, 5, 6, 10 of these stories per year that will go right, and 3 or 4 that will go wrong. But overall, you'll do really, really well. But this has to be your thing. So your, drop kick that you're going to practice 500 times a day is how to spot gamma squeezes, for instance. But this, I don't find these sorts of stocks respond at all well to the analysis I've just talked about.
Right. Okay. Thanks for that.
It's
so
very,
it's a whole
very
different.
Yeah, it's just
whole
a different
ball game, whole different skill set.
Yeah, and obviously you can make fantastic money on the long side and on the short side with stories like this. Of course you can. But it's a different method, in my view.
Right. Okay. Thanks for that.
All right, great question. Thank you. Prasad, you're on.
Rex,
Hey, how you doing?
can you talk about Zscaler, Intel, and Okta?
We can, but can we finish this
Sounds good.
topic first? Is that all right? And then can we go back to those?
Sounds good. Yeah.
Okay. Right. So we don't have too much to do on this session, but we have a lot of folks that have joined us today and a lot that will be watching the recording. We just want to concentrate on method if we can. Just 1 second. Okay. So let's just finish off these examples that we have here, and I will come back to those right at the end, Prasad. Okay. So we've walked through the S&P. We've talked about that in some detail. We've actually talked through the NASDAQ as well. So we've covered that. I wanted to finish off with, I'm really sorry, this is a mess of a chart when you look at it, but this is a real world thing that we covered on the way up and on the way down. And actually it's not a huge, big liquid stock. It's Iridium, which is a relatively small business, but it happened to trade perfectly to this method. So this is just a set of overlays of everything I've talked about. You've got the accumulation down here. So this was between, I'm going to say the end of 2018 and early 2020, sideways, lots of volume at this range bound lows. A breakout markup zone. This was a wave 1 up, a 61.8 wave 2 low, a 1.618 wave 3 extension, and then a wave 4 down where the wave 4 tickled that wave 1 high, a 5th wave up. Wave 5s, by the way, typically finish somewhere between the 0.5 and the 78.6 extension of the wave 1 to 3 combined, place of the wave 4 low. We call distribute up here. You see the big volume spike up here of distribution. What then follows is markdown. The stock's in free fall. We charted an A, B, C decline, and the stock is currently back under accumulation as measured by the volume here. The clock starts here. Middle of 2022, and you can see the big volume here when there was selling and the big volume here when there was buying. That's a real world thing. It was in our service. We called it buy in accumulation, hold through markup, sell in distribution, do nothing in markdown. You could have shorted it if you wanted to, and buy again down here. So this stuff works if you do it right, and if you learn how to control your risks for when you inevitably get it wrong. So you learn how to use stops and hedging based off of these charts. And again, Iridium, you know, I can give you 400 reasons why Iridium stock is a terrible idea to buy, you know, and they start with letters S, P, A, C, E, and X, right? And there's 400 other reasons as well. But that's not what the stock chart is telling us. The stock chart is telling us this is a good idea to buy this stock. And so we'll see what happens. We'll see whether reality triumphs, which is SpaceX, Project Kuiper, and a whole bunch of other things should deflate Iridium almost to zero, right? It should be a terrible idea to buy this stock. That isn't what the chart is saying. In my experience, charts usually beat the narrative that one conjures up in one's head because you've inherited that narrative from stuff you've seen on the TV, stuff you've seen on Twitter. All of this truly is a mind virus. Narrative is a mind virus that should be avoided like the literal mind virus plague. Charts, volume, price, and patterns, that is the only kind of reality, in my opinion, in stocks that can be trusted. Okay, Prasad, let's do those three stocks and then we're going to finish as we're quite a bit over time. So, sorry, it was Zscaler, Intel, and Okta, is that right?
Okta.
Yeah, okay, let's do those. And then we're going to finish up. Okay, so
Zscaler apparently fell after the earnings, right? It had a good earnings, I thought, but it just fell and it kind of recovered, but still not back to pre-earnings.
Yeah, so it looked like it dropped and it's sort of bounced back somewhat. So this is longer term Zscaler, COVID lows 36 to 3. Anyone who's not familiar with this is a cybersecurity software business, good business, highly volatile stock, as you can see. So wave 1 up to 375, wave 2 down, really, really deep correction below the 78.6 retrace, move back up. We've had this accumulate between 140-ish and 203-ish, defined by these volume nodes here, right? So the buying really starts here. That's that big bar there. Time equals 0 is April 22, when in general accumulation in stocks started. We had a false breakout here into the markup zone between December last year and March this year. It dropped back into accumulation, started to break out, dropped a few points of earnings, and sort of recovered. So what I would guess is happening, Prasad, although I don't know, I have owned the stock, I have made good money from the stock, I don't own it at the moment. That looks to me like that price 203, I'm going to call it, that high volume node there, that looks like it's being defended, because if you zoom in, you can see that yeah, there's a wick up and down, but that 203 price is held. So my guess is that's going to keep moving up, would be my guess. You know, if wrong, you know, where's it going to drop to? Well, it will drop pretty easily down to 190, I would have thought, because there's a big volume hole there. So stop at 190 or something would be my guess. Okay, you then asked about Intel. Sorry to rush, we're just over time, so let's whip through these. So I do own Intel for disclosure. Okay, so Intel, we have here we go. That's what I think about Intel. We're in an accumulation period after this initial drop. So the stock bumped up, as you know, on Gelsinger's resignation, since fallen back. I saw the news today that says they're probably going to separate the foundry and the products business, the design business. After all, I'm comfortable holding Intel. This is an American corporate recovery story. That if you're going to reshore semiconductor manufacturing, as I've said many times, that has to involve Intel. Perhaps it involves Intel's assets not owned by Intel, but if there's a breakup of the stock, I would expect that to be bullish for the stock. So I own Intel, own a reasonable allocation. I don't mind holding it personally. It's really difficult to trade, but as an investment to hold, I don't mind holding Intel.
So how many do you own Alex?
I can't quite remember, but I'm going to say about 3 or 4 units, I think. So for context, I own about, my biggest single position is TQQQ, and I've got, I'm going to say 37, 38 units of that. So Intel's a relatively small holding for me. It's a reasonable, it's big enough to worry about, but it's not, it's not sort of personally determinative, if you like.
So you don't think like it's in the accumulation, right? Like SPY and QQQ, they're all kind of close to markup and distribution, right? But this is an accumulation zone.
Yeah,
So why not
because it's
more
not. Why not put more in? Because it's highly risky, and I don't care to have too much risk in single stock names personally. It hasn't served me well to go right. I know, load up at the lows. What served me well is play those wave patterns in the big liquid indices and stocks, and I've done much better like that since rather than chase, buy this dip or buy that dip or any of that. I've done much better, much better with lower volatility, lower risk, much more consistent results, lower pulse rates, no stress. Suits me much better. I happen to own Intel because I think it's a terrific American recovery story. I think it's a great reshoring story. I think it's absolutely aligned with the stated goals of the incoming administration. I think it's a good single stock story, but I would not put a significant part of my net worth into it. Why would I? Because I might be wrong. Whereas a significant amount of net worth into the S&P, which is relatively non-volatile, tends to go up and can be hedged. That seems like a good idea to me.
I see. And the stock actually, is it a good thing that the CEO got out? Like the stock has pretty much jumped about 20% now since the CEO's ouster. So isn't that a good thing for Intel that they'll probably get somebody better?
Yeah, I think so. I think that, Gelsinger clearly hadn't achieved what he set out to achieve. I think that as usual they'll just pin it all on the CEO, and in fact, the problems will run much deeper, and the board, clearly haven't done their job either. So, but I think it's a good start to change the chief exec. Yeah.
Can you do the short-term chart for Intel?
Okay, but we're 15 minutes over time, so yes, but I don't. The answer to Intel, in my opinion, doesn't lie in the chart. It lies in, is it an American stalwart that has to recover for the good of US Inc. or not, right? And so is it Boeing or not? If it's Boeing, it's going to do fine. If it's not Boeing and it gets tossed to the walls, the stock's going to attack. And that's the answer to Intel. Look, here's as you can see, this chart is not working very well, right? So I guess you would say, all right, there's your wave one high. We'll rechange that around. Let's just drag this out a bit. I'm not going to do Octopresso. We're out of time. Okay, so let's finish on this. Okay, so that's how it's looking, I think. But this is a crazy drunken pattern, as you can see. So what would you think? You'd think the stock can probably drop to $20. If the stock drops to 1850 or below, then there's trouble. But honestly, my opinion on Intel is, why do I own it? I own it because I think it will be an American recovery story. I think that it has scarce assets, namely its semiconductor fabrication assets, that are required for the US to achieve semiconductor manufacturing reshoring. And therefore, I think the value will accrete to those assets and therefore to Intel stock. It also, by the way, owns 80 or 90% of Mobileye, which is a sort of key element of self-driving tech in companies that aren't Tesla. So I think there's many routes to value here, but this isn't a technical trade. This is what I do is I've got some money in it, and I'm just sat and I don't even look at it day to day for the most part. The S&P and the Nasdaq I look at 10 times a day because they are technical trades. But this is does it recover? Does it not recover?
Yeah, I entered around 26, and I'm like sitting every last 3 days. It's like every day it's falling like 7-8%. Right?
Well, then you've got it. But all you can do is go, what's my risk tolerance, right? Because that's just a way to get stressed. So you have to go either, if the stock's below X, then my thesis is wrong and I want out because that's enough loss. Okay, I'll set a stop loss there and I'm gone. Or I own a sufficiently small allocation to not stress it. And if it goes to zero, then I don't care. So the other reason for me to have small allocations to single name stocks is if it goes to zero, it doesn't really make that much difference to me. Right? That's the other reason I do it, because the S&P isn't going to zero. I mean, probably isn't. Intel isn't going to zero, but it might go to 10. And so if Intel goes to 10, I don't really care. If it goes to 30, I don't really care. I'd rather it went to 30 than 10. It doesn't make that much difference to me. What would make a lot of difference is if the Nasdaq dropped 20% tomorrow, but that's unlikely to happen. If it did, it would probably bounce and give me an opportunity to get out, because the Nasdaq and the S&P and the Dow trade to technicals, whereas Intel, doesn't.
Makes a lot of sense, Alex. But given that I've already gotten such a big position at, and I'm sitting at a big loss, do you think I should hold on just for a bit of good news?
You got to decide that. I said I can't tell you the answer to that. Right? You know that, right? So only you know the answer to that. Only you know your risk tolerance. Only you know the allocation relative to your comfort level. Only you know your emotional approach to the stock. I can't tell you that. You've got to make that decision. Okay, folks. Right. Well, look, I enjoyed myself anyway, so hopefully the webinar was useful. We'll post the recording in a couple of hours once it's all upscaled to HD. If you have any more questions on method, or frankly any of the stocks that we cover or the indices that we cover, have at it. If you are a subscriber to any of our real-time services with chat, hit me up in chat. If not, then use the YouTube comments field, and we can do that. And if you want to reach out to us, then you can use, there's a section on our website, footer of the website, called Ask Us Anything. Hit that button. Or you can reach us at Minerva, Minerva, at sestreamcapital.com, and I'll put that on the YouTube link. Thanks, everyone. Speak to you all soon.